Donald Trump has just announced tariffs on Australian exports, and while everyone is focusing on the impact on beef, wine and other exports, almost no one is talking about how this could affect property investors. Because behind the headlines, markets have already shifted, interest rate expectations have changed, and the flow-on effects could impact how you invest in 2025. So in this video, I'm going to go through what Trump's decision means for Australia, why it matters to property investors in 2025, and the opportunities or risks this new environment could create. But in order to understand the impact these changes will have, we first need to look at how the Australian property market currently operates. You see, we currently have a shortage of properties in Australia of around about 300,000, according to AMP. That's expected to increase to nearly 400,000 by 2029. So what that means is we currently have and are expected to have even more buyers looking for properties to buy than properties available for sale. So what do you think is then likely to happen to property prices when there are more buyers, so more demand, not enough properties, not enough supply? Based on fundamental economics, prices are likely to rise. So with that in mind, let's have a look at how Donald Trump's tariffs changes things. Australia is no exception. We are being affected by what's happening in the US. As a result, the Australian share market has plummeted. It's had a crash similar to what we saw when COVID was first announced. The Aussie dollar has also plummeted to its lowest levels in 20 years. So with all of this economic turmoil, with all of this economic concern, what do you think the Reserve Bank of Australia will do to interest rates? Well, many major lenders are expecting up to another 4 interest rate cuts in 2025 alone. Now, with a backdrop like I mentioned earlier on, where there are not enough properties already in multiple markets around the country, when we have up to 4 rate cuts, that means that people's borrowing capacities will increase. That means people can take out bigger and bigger loans, which means you're going to have more buyers coming onto the market at a time when we already have a shortage. And what do you think that's going to happen? Well, just like what we saw after COVID when there was so much economic uncertainty, property prices rose. In fact, as you can see in this next chart, when COVID first occurred, property prices dropped all of 1.7%. But then they increased an astounding 33.1% over the next 2 years. Imagine how it would feel if you bought an investment property today and it rose by over 30% in the next 2 years. I think something like that is very, very possible. And this isn't new. Home price rises during recessions. My housing market economist, Andrew Wilson, said Australia had a long history of home price rises during times of economic shock. Australian housing markets are very sensitive to rate changes, especially rate cuts, he said. Historically, prices go up following interest rate cuts, even during times of great uncertainty, because issues of sentiment can wane when the realities of improved affordability hit. So what that means is that, yes, there might be so much economic uncertainty out there, but when people in Australia feel that they have a better chance of affording their own home, they will go for it. And that has been proven throughout history. Even in times of economic hardship, the stimulus of lower interest rates can push up prices. And we saw that during the global financial crisis and during COVID, like I mentioned earlier. Ray White economist Nerida Conisbee said Trump's tariffs had raised the prospect of more interest rate cuts, in addition to the last cash rate cut announced by the Reserve Bank in February. Economic upheaval has dramatically altered interest rate expectations, Ms. Conisbee said. As of 8th of April, markets anticipate an almost certain 0.5% rate cut at the next RBA meeting on 20 May. So that's the equivalent of 2 rate cuts happening in one go. Such reductions would benefit mortgage holders significantly and will almost certainly direct more money into the housing market, supporting both housing supply and price growth. So what this all means is that if you're someone who can afford to buy an investment property, there is a great opportunity for you to get in now before prices really take off and maximize the opportunity that Donald Trump's tariffs potentially present you. Over the last week, I have had a huge influx of people reaching out to us to find out how they can use their self-managed super funds or how they can set up a self-managed super fund to invest in property. Now, that makes a lot of sense because, like I said earlier on, in times of economic turmoil, Australian property has almost always proven resilient. Prices are expected to rise again. And if you're someone who's worried about what Donald Trump's tariffs could mean for the share market and then your potential super balances and your retirement, it makes a lot of sense to potentially look at setting up a self-managed super fund and buying property. After all, property does not have the same up and down volatility like the share market has. It has the opportunity for you to use leverage, which means you can make potentially leverage gains over the next few years without the risk and volatility. And so I'm seeing a lot of people looking to move across into SMSFs, self-managed super funds, and buy properties. And I fully expect that will also further place more demand pressure on the property market. You have all these people looking to plan for retirement, potentially saying, well, look, we are too worried about what's going to happen in the share market over the next 5 to 10 years. We want to shift those funds across to property. That means you have more buyers again looking to buy property, which will further stimulate demand, further driving property prices higher. When COVID happened, interest rates were cut dramatically, and we saw so many people move out of inner city Sydney or inner city Melbourne. Many people said, oh, this is because people can now work from home. Well, that might have been part of the reason. But the other part of the reason was that a lot of these people felt that they now had a chance to buy their own home. They did not want to live in an apartment. They wanted to live in a house, even if that was further away. That's what also drove a lot of people to move out of the big cities into the smaller cities like your Brisbane, Adelaide, and Perth, plus multiple regional markets. People went where properties were more affordable. And I fully expect that you're going to see that happen again as a result of Trump's tariffs. Interest rates are going to fall. People will say, okay, now is the time to buy our home and we don't want to live potentially in an apartment. Where can we move to where there's still good opportunities for jobs, where potentially there's good schools for our kids, and we can afford to buy a house? And that's why I fully believe that the more affordable segment of properties, they are the ones that are more than likely going to take off first, as there'll be more demand there, and that will then drive property prices higher across most of the rest of the market. So again, if you're someone now who's thinking about buying a property and say you have a budget of less than $750,000 or less than $700,000, please don't go and make the mistake of thinking, oh, if you can't afford to buy a house in, say, Sydney or where you live, buy an apartment instead. No, instead, look to see where you can get a house that's within your budget in an area where people are moving to because there's strong opportunities for work and schools, like I said earlier on. That will give you a far better capital gain. I fully expect that people who start looking to buy apartments, especially as I think you're going to see a lot more apartments being built as a result of some of the government changes, which I'll come to in a moment, you will see a lot more supply when it comes to apartments, which will negatively impact your capital growth. So don't go and make that mistake. Focus on buying houses. By the way, if this all feels like a lot to keep up with and you're like, well, you're time poor, you don't have the time to do all the research, negotiate with agents, go and inspect properties, especially in areas where you don't live, then my team offers you a fully done for you solution where we can help you source the right property in the right area without you needing to leave the comfort of your own home. So if that's of interest, check out the link in the description below to book a no obligation free call with a member of my team. So Trump's tariffs are definitely shaking things up, but he's not the only one shaking things up. This year's federal budget also announced some major housing reforms and incentives that could really reshape the property market in the next 12 months. So if you're someone who's thinking about buying an investment property this year, I encourage you to check out this video next.